So guys, it's 8 o'clock, so I'd like to get ourselves going. I see that most of us are with us, and we've got a few that should be joining us in the next few minutes. A couple of things while we're waiting for some people. When I put together the syllabus for the course, I wasn't thinking much about U.S. holidays. There's only a couple of them that I pay a lot of attention to, and those are Christmas and Easter and Thanksgiving. And it completely escaped me that Monday the 25th is the Memorial Day holiday here in the United States. And some of you probably have plans or might have plans for that day. More importantly, the college asks us not to hold classes that day. So if you look at the syllabus, you'll see we have a full schedule that day. And we're going to go ahead and move that schedule from a live schedule to one where we have the presenters and the discussant actually do their work, record it, and then provide it to all of us. We'll all be responsible for the material that they're going to be presenting. And I'll spend some time directly following our class today talking to all of those. And just so you'll know, that's Noah, Abasi, Donnie, Jack, Jacob, Braden, Zane, Lee, Paula, and Dion. A few of them may not be with us quite yet, so I'll have to repeat some of this toward later on in class. But after we're all done this morning, I'm going to ask all of those people to stay with me so I can discuss how I want you to line this out. I think we can make it such that it's engaging enough that everyone will appreciate being able to view the sessions. And then you can bet that there will be a quiz session in the class following. They'll be related to the material that will come from it, just to give you a little bit more motivation to view the different recordings that these students put together. So I apologize for having overlooked the holiday. Maybe in less uncertain times where we were being able to get out and do more and gather, maybe I wouldn't have, but this year it completely escaped me. So this morning we've got three direct presentations and then a guest. We'll first be hearing from Alex and Skylar on valuation methods. We'll then hear from Fred Copley on regulations and legislative actions, and then Jaden Casto on the Jobs Act. At 10 o'clock, Jessica Sudweeks with Disclosure Law Group in San Diego will join us. She is an attorney that focuses exclusively on dealing with public and private investment disclosures and filings, and the companies that are her clients are all publicly held companies, even though they do have some private market activity, and she's rather well versed in the private market as well. We're also going to spend some time in breakout groups, and that's what we'll do for the last half hour or so of our time together this morning. And those breakout groups, of course, will be discussing the different questions posed in the open table case. And as of about 15 minutes ago, I noted that group 7 and I think group 4 had not submitted their questions or their comments on Canvas yet. You're going to want to do that here before the day is out, because we've got a due date on this. But we'll be discussing those items as we then move into the last half hour of our discussion today. So with that, I'm going to go ahead and make sure that you guys can all share the screen. You can. And ask that Alex and Skylar go ahead and teach us about valuation methods, which a few of us on this Zoom know a little bit about. And I will actually be serving as the discussant for this, following this morning. Alex and Skylar, take it over. You know, Alex, I noticed that you pretty much always lead with that picture of you guys on the mountain without any shirts. We'll have to discuss that at some point, brother.
Well, hello, I'm Skylar Schlander.
Hi, I'm Alex Coultier.
So we'll be doing our presentation on valuation methods, value versus price. So kind of the order and the way that we're going to do things, so we're going to bring up what value and price are, some of their differences, and then we're going to go through some valuation methods, and then we'll go through a conclusion period. But we would like to save questions for the end. And it appears as though we have Rick as our discussant, so we have the master for questions. So if you have any, just make sure to write them down and we'll get to them at the end.
You're a funny man.
So what is price? Well, I think that the easiest way to think about price is price as what a person is willing to pay for a product, and price is set by supply and demand. And so the higher the demand, the higher the price is going to be. And in finance, for stock price, we can see that it's driven by moods and momentum, and so it's based on like expectation of people for a company, and so what they are willing to pay for what they think this company is going to give them later. You can see that I wrote down some tools, so I won't go over it now. We're going to talk about these tools later in the presentation, but you can see some tools related with price. And then value. So same, the easiest way I think to think about value is based on product characteristics and what this product is worth as today. So in finance, we can see value as cash flow of a company, and more future cash flows of this company, and more precisely, what are they worth as today. So obviously, value is going to be driven by cash flows, but also the growth of these cash flows in the future, and the risk of investing in a particular company. Same here, you get some tools that are useful to find value of companies. We're going to talk about them later. So now let's take a look at price and value together. And first interesting point is that on one hand we get price, and as I told you, price is set by supply and demand, and so there is not really a frame for price, such as if you have no demand, like the price will be zero, and if you have like the whole world wants it, then the price is going to drop, like go up to infinity. And that's the same with stock price. The price of a stock can go down to zero in a couple of days, and then can go up to like 100 or whatever in the same time frame. So it's very it changed a lot. And on the other hand, you get value. So value has a frame, and we can see the frame of value with the lower bounds will be with a pessimistic valuation, so with a lower cash flow, even negative cash flow, and a lower growth and high risk. And the higher bound will be with the high cash flow, higher growth, and lower risk. So even though people are not always agree on, they disagree on like these bounds and their value, they will always agree on the fact that there is bound. Another interesting point is that how value and price react to information, and we can see that information has a lot of impact of the price and not on the value. So for example, in the market, which is a pricing mechanism, in the market you can see that a little piece of good news can push the price higher when the market is in a good mood, and a bad news won't affect the price. However, when we are in a bad mood like today's, a little piece of bad news can drop the price of a company heavily. And on the other hand, for value, the good news and bad news won't affect value or less, because you're going to use this information to change the variables to calculate your value. So will have an effect, but more measure, like more realistic effect, and not as bad or as good as with the price. So yeah, as I was saying, markets are pricing mechanism, and we can see that even more today when indexes all around the world are losing and earning trillions a day. It's fluctuates a lot. And also price and value. So we can think about, are they converging? So because they should be, but in the reality, they are not converging. They're most likely diverging. And so why are still people investing if they know that value and price are not converging? It's only because they still believe that at a certain point in time, they're going to converge close one another. And so we can see the gap between price and value as an opportunity. And you might wonder why I put a picture of hand sanitizer. And that's because, I don't know, for me, that was kind of like an easy picture to see difference between price and value. So the value of a hand sanitizer was like the same 1 year ago than today. But the price, as you can see, went up a lot because the demand went up a lot with this crisis. So that's kind of like simple way to look at it. So now we talked about price and value. We're going to start talking about valuation. And first question will be for you guys, why do we use valuation in finance? And I would like, if it's possible, that people who didn't take finance, Theo and I, answer that. And even though you don't have a lot of knowledge about that, that's the point. Just think about, why do we want to use, why do we want to value a company? I know there is a couple of you like Henriette or... No?
I can make a guess. It will probably be because you have to figure out how much, if you're going to sell the company or if somebody's going to invest in it, they have to know how much they should spend on it. Because, like, compared to this and a hand sanitizer, you wouldn't pay $100 for a hand sanitizer last year. So the same with the company, I guess.
Yeah, that's a good point. Like, valuation is very useful when you want to sell or buy a company. And there is also, so like for investing, if you're investing, you want to know if the value of a company is close to the price, or like if the price of the company, the stock price is higher than the value of the company, then the company is overvalued, and when it's the opposite, the company is undervalued. So as you say, it's useful to buy or to sell a company, and it's also useful for CEOs and to analyze performances with other companies, as well as in historic, like to see if they are doing a better job now than before. And same, we will go over that in the next part.
So now we're going to go over the different business valuation methods, and there's 3 different approaches that we use. First is asset-based, then we have income-based, and then we have market-based. So first, going over asset-based approach, there's kind of 2 main approaches. The first we use is called the going concern approach. And so for this, we take total assets, we subtract off total liabilities, and we end up with total shareholders' equity. And then the next form that we can do is a liquidation asset approach. And so what we do here is we take the cash value of the assets in the business, and we subtract out any outstanding liabilities, and that leaves us with the cash that we'd have left over if we were to liquidate the company. So here's a couple advantages and disadvantages for the asset-based approach. The first advantage really is that was a quick and easy method, but the disadvantage is it's not used often because it really doesn't go into a whole lot of depth for the business. It doesn't really do a lot of analysis on why things are the way they are, as well as it's hard to discern assets. So what that really means is in a sole proprietorship, you might not be able to distinguish a personal asset from a business asset on the balance sheet. So an example of that would be a business owner has a car that is on the balance sheet that he uses to drive to and from work. Well, when you're buying the business, are you buying that car from the owner, or is the owner keeping that asset?
Can you go back to the other slide real quick? I just wanted to write down those equations real quick.
Okay. Wait.
This time?
Posting this PowerPoint. In fact, we post them from each one of the presentations and place them in Canvas directly underneath the topic on the in the concept development module, if that helps you.
Okay, awesome. Yeah, I just took a picture. Thank you.
Okay, so now we're moving on to the income-based approaches. The first one that we're going to talk about is the capitalization method. And for this, we're going to have to forecast future earnings, and then we normalize any of the annual profits for irregularities, and just to make sure that we can get a decent average that we're using. And then we have to identify a target rate for return of investors. And really, during our research, we found that investment-oriented buyers look for around 10 to 20% on this return for investment. So I just wanted to show the equation right here is expected annual profits. Then you divide that by the desired rate of return, and that gives us the valuation of the business. So quick example, if we had average annual profits of $50,000 and we had a rate of return for 20%, we would end up with a value of $250,000. So now we're moving on to the discounted cash flow method, or DCF, which everyone in 309 is really familiar with. It's what we worked with a lot. If you haven't taken 309 yet, a lot of these equations and the process might seem a little complicated. We're going to walk through that really quick, give a generalized overview. So if it looks a little hectic for you, don't worry. If you take 309, it really starts to make a lot of sense. So to start with the DCF, we have to first project our revenues and expenses. And to start with that, we need a short-term and a long-term growth rate. So we have a short-term growth rate. So what that is we look usually 3 to 5 years and what that industry that the business is in looks like it's going to grow at. And then we have to distinguish if that business is going to outperform, perform at that level or below that level. And then we need a long-term growth rate. And so in saying that we need a long-term growth rate, we're acknowledging the fact that if we set a 15% short-term growth rate, we don't think that forever that business is going to be able to achieve 15% growth. So we call the long-term growth rate the terminal period. That's what we think the business could get for perpetuity or for as long as the business is in business for. So after we project our revenues based off our short-term and long-term growth rate, we need to forecast all of the expenses associated with that. So just a quick, to jog our memory, people that have taken 309 or that haven't, could someone tell me the equation for free cash flow?
Now you're just being mean.
Any takers?
Yeah, it is NOPLAT, which is net operating profit less adjusted tax, plus depreciation, minus change in net working capital, minus net capital spending.
Yeah, that was perfect. Yeah, so as Jaden had said, NOPLAT is just a fancy way of saying we've tax adjusted our EBIT, which is earnings before interest and taxes. We're adding back on depreciation. We're subtracting any change in net working capital, and then we're subtracting net capital spending, which is just a look at our change in our fixed assets, and then plus depreciation again. So now we're getting into some of the more, I guess, advanced formulas right here. So if it starts to fade off for you, don't worry, you kind of figure this stuff out as you take 309. But we need to determine a weighted average cost of capital, or as we call it, WACC. So you'll see the left side of the equation is our cost of equity, and then under it is our cost of debt. And so what does that really mean? It's what we think the cost of either our equity financing or our debt financing will be for the business. So specifically for cost of equity, we use an equation called the capital asset pricing model, or CAPM. And this is really just a way to look at some sort of risk and then a premium on top of the risk plus our risk-free rate. And then we also have our cost of debt, which is usually, if you're using bonds for a business, just the current yield. And then we look at the percent of equity and percent of debt. And so it is a weighted average. So we take the cost of debt, we multiply it by the percent that equity financing is used in the business. And then we take the cost of debt and do the same with the percent of debt in the business. And then an important caveat with debt is that we have to multiply it by the tax rate. So now we have our weighted average cost of capital, our revenues and expenses. We have to discount our cash flows for rate and time. So as you'll see in the equation at the bottom, we have the sum of cash flows discounted for year 1. We have plus the cash flows of year 2, and all the way on. So now we have the last equation, which is CFN, which is basically our terminal period. So that's where that long-term growth rate comes into effect. And so we add up the cash flows that are discounted for rate and time over the explicit period, the first 3 to 5 years. And then we add on discounted the terminal period cash flows. And that essentially gives us a valuation for the company. So I'm going to go over some of the advantages and disadvantages of an income-based approach. The first advantage for an income-based approach is that it requires forecasting. And so what I mean by this is the free cash flow model. You have to look at depreciation. You're going to have to look at what assets it's going to take to build the business. And you're also going to have to look at what capital expenditures are going to go into those assets, as well as the depreciation off those assets. Another advantage is that you have to use the time value of money, especially for DCF. And it also assesses risk in the business through the CAPM model, where we have that risk premium. So some of the disadvantages of an income-based approach, it's very calculation intensive. So if you don't have a whole lot of practice using DCF or a capitalization method, it might be a little daunting to either value a business or value your own business. As well as an income-based approach, there's a lot of assumptions, and a lot of the growth that we think we can get might be based off of the best owner for that business. So it could be the current owner. You could be coming into the business thinking you can run it better. So you have to change that growth assumption based on what you think the owner plays a role in the building of that business.
So now let's take a look at market-based approach, and so there's kind of two ways to do that. And so the first way is to look at other companies and compare them with your company. And so the first method, guideline public company method, is very useful for private company. So what does that mean is you want to find a public company that is very similar to your company, and then you're going to calculate some multiples or ratios of the public company, and you're going to use it for give you a value to your private company. So for example, you want to find a company in the same industry with a similar gross profit or cash flow, or you have to decide about that. And then you want to find, for example, their EV/EBIT multiple and do this multiple times your EBIT, and you will end up with an idea of your value for a private company. Another possibility is also to look at sales of comparable business, so the sale of comparable business method. And it's just basically trying to find if a company similar to yours have been sold recently, and at what price. Can be hard because it can be hard to know the exact price of the sale, but it can be very useful when you don't have a lot of information. And so I added price and enterprise value multiple. So we're using it in the guideline public company method, but it can also be used by a public company and used based on your historic or based on competitors. For example, if you used to have a EV/EBIT multiple of 10 the past 5 years, you can use this multiple to know the value of your company as today. But also if you know that you're planning on growing and you wanna be bigger and you wanna like be the leader of your market, you can look at the EV/EBIT or another multiple of this leader, and you can use it to have an idea of the value of your company if you succeed in growing.
Can I
So,
interrupt there? Or Alex, can I interrupt you just to ask what's EV? I know what EBIT is, but not EV.
sorry, so EV stands for enterprise value. So that's
Okay. Perfect. Thank you.
the equation of enterprise value is going to be the debt plus the equity, so preferred equity and common equity, minus the cash of the company.
Oh, okay. So it's not the same as earnings before interest tax, right?
Sorry?
The other. It's not the same as EBIT.
No.
No. Okay.
No.
Gotcha.
Yeah, no. And so all that methods are useful to, but like they're based on price, not on the value. So I think these methods are very useful because they're easy to use and it's fast. And also, since they're easy to use, they're also easy to understand for people when you want to negotiate with people. It's going to make sense for them if you tell them that, okay, our company is similar to this company because we have the same cash flows or whatever, and they're using these EV/EBIT multiples, so we use the same to end up with this value. They're going to make sense for them. However, with these methods, since they're very broad, it's hard to analyze too deep with these tools. So you will have a sense of your value, but you won't be able to know why your value is high or why your value is low. And also when the market is wrong, as we saw before, since market is price mechanism, if the market is wrong, then your value might be wrong too. So now how you can use these methods? Well, first thing, you want to see them that like they complete one another, and they will give you a range to negotiate. So going back on the lower bounds and higher bounds of value, thanks to these methods, you can have a lower value and a higher value, and you want to negotiate in between that range. And also some of them, like the discounted cash flow, are very useful as a managing tool. And so thanks to that, the owner or companies can see why they're doing great or why they're doing bad. Is it because they have not a good cash flow, or like they're too pessimistic with their growth, or is it because they have a cost of capital too high? And also, thanks to all these methods, they can have a sense of if the company is undervalued or overvalued, and depending on that, they can choose to some like financial decision, like selling stock or buying back stock.
So when do we use these different methods is kind of the question I would have. So we're going to try to go over that really quickly. There really is potential to use all three of the methods. Each one just gives you a different perspective of how the business is run or the price or the valuation. And what you can do is you can use these different values to create a range if you were to sell your business or if you're looking to acquire a business. But with that being said, there are some industries that rely heavily on different approaches. So industry experts in the automobile sales area or franchises might tell you that they rely specifically on variables such as blue sky. So I know Nicholas is super familiar with blue sky. And then at the end of the day, a business is really only worth what someone will pay for it. It's kind of, so we'll move on to the conclusion part is, so an important thing to really note from our presentation is that value and price are linked, and we need to use both just in consideration when we're valuing a company.
Okay, nicely done, gentlemen. Thank you. And these are your citations, right?
Yeah.
Which, frankly, none of us are going to pay attention to. We're just grateful that you did. So let's go ahead, and I'm going to ask you to leave the screen shared for a few minutes because we may go back and forth to some of your. Nope, I want you to leave it shared. So continue your sharing. Go back so we can see your PowerPoint because we may reference back and forth to it a few times. Let's go ahead and start with any questions that we might have. What questions do you guys have with respect to the presentation so far? Some of you are actually fairly experienced private firm valuators. Any questions or comments with respect to what we've seen here from those of you that know more than a little bit about this? Okay, you're killing us.
I can go with the question. I think it's kind of interesting to talk about the enterprise value. So what I would like to ask you that can enterprise value alone be also used as a snapshot valuation of a firm to tell what the firm is worth?
Is that question for us or for Reed?
No, it's a question for you guys. You are the experts at the moment.
Okay.
Ooh. I mean, that would come very close to an asset-based approach. I don't know. We have used specifically enterprise value for the multiples purpose. I haven't really looked at using an EV as just its own valuation tool.
Well, think about this for a moment. What is enterprise value? I mean, you're putting it up here as, I think you even gave us the equation a few minutes ago, and somebody was asking you about it. Well, really, Alex, what is enterprise value to us as investors?
That should be the value of the company, like it can be, I mean, for, at least in my opinion, that will be the market cap of the company plus its debt, market value of debt, and so minus the cash. So that will be a good idea of the value of the company on the market.
So in practical terms, when we're dealing with private companies especially, or smaller companies, do we always subtract all of the cash, or are there conditions in which we might not?
I don't know.
So I'm gonna turn to Gary for a minute. So Gary, you didn't put together this presentation, and I don't think you've taken Finance 309. I'm going to guess you haven't done a lot of private business valuation. You're going to want to come off of mute. Good. So if you had a company and it had zero cash in it, none, all of the financiers had subtracted all the cash away, how difficult would it be for you to run the company?
It would be very difficult. It's very interesting, that question, in the sense that cash a lot of the times is, supposed to be very valuable. However, assets, it's a really good way to increase the value of a company. Alphabet is a really good example. They own quite a bit of companies, and they're able to just use all their assets for the valuation of their company. As far as I understand, that's how they look at the evaluation.
So cash is very important. In fact, without it, we can't run the company. We think of it as the lubrication in the cogs that are this company. So coming back to this enterprise value structure that you guys are talking about, I think that enterprise value probably needs to consider, are we subtracting all of cash, or are we just subtracting surplus cash or excess cash? In which case, I think we would probably agree that if you're going to try to keep running this business, you're probably only going to be subtracting surplus cash, which brings us back to try to answer the question that Victor is asking, and that is that the enterprise value is the value of the company, no matter how you calculate it. Do we have more than one equation, Jaden? I'll let you come off mute. Do we have more than one equation that will help us get to enterprise value?
Yeah, I mean, that's kind of what this whole presentation was, right? All the values we were determining were just variations of enterprise value.
It's exactly right. It's exactly right. What other questions would you guys have?
I have a question. What was the blue sky variables you were talking about? I don't think I've ever heard of that.
Yeah, so that's specifically used in franchise. I know Nicholas is smiling right now. He definitely knows quite a bit about these, but just franchises, they're operated a little differently. So they have blue sky variables, especially like auto industry. I know Nicholas probably has the equation in his head of how to get there, but yeah, if he wants to come off mute, you can kind of say more about it.
Yeah, well, yeah, blue sky variables, or they're just multiples. So they're different kind of multiples to calculate the goodwill of a company or the equity value. They're specifically used in the auto dealership industry, where or where the value of the dealership is really tied into what kind of cars or what brands you sell. So it's really like a multiple based approach that's taking some cash flow and using a multiple to get a equity value for the company.
In fact, Nicholas, aren't they actually just another form of evaluation model? But in this form, we actually get to recognize the net tangible assets that might have some value for us over and above that which the cash flow has.
Yeah.
That's what I thought. So,
Real quick, because just so, and I think in the next few presentations, the term blue sky comes up again when talking about blue sky laws. It's just a thing having to do with securities. Do those have any connection why they're both called blue sky? Like, is there any connection to that?
I haven't found anything that connects it directly to the law. I think they might be standalone.
Alex, do you have any input on this?
No.
So we tend to use the term blue sky as maybe a little more broadly than we should. So there are some blue sky laws, and these are state securities laws, and they really have nothing to do with the blue sky valuation method or blue sky as in the intangible asset value of goodwill. They're really three different and fairly unique from each other concepts. So it's interesting. We do use that same term in this kind of sphere, but we sometimes do it indiscriminately. So that's actually a really good question. Hey, let me throw another question to you guys that put together this presentation. So just in a nutshell, what's the difference between price and value? A good deep dive, but I'm just a simple guy. I'm an investor. What's the difference between price and value?
Well, I don't know if that was me. I will just go again on that picture of the hand sanitizer, and like, so the value is like what you should pay for an object, and the price is what you have to pay for the object to have it. If I had to make it simple.
Okay, but here I am in the midst of COVID-19, and yeah, I might be willing to pay that $107.99 for the Purell because I know I'm about to walk into a room of 85-year-olds who are at high risk, and I'm going to guess that to me and to them that has a significant value, given that if I share the germs that are on my hands, and by the way, I just came out of a dormitory for undergraduates at Westminster, so my hands are reflective of a petri dish. So I'm going to guess for me and for them that sanitizer has a tremendous value.
May I speak?
Please.
Isn't that the difference between trade value and use value?
Yes.
And although coming from a Marxist standpoint, isn't value like pretty strictly defined as the, according to the socially necessary labor time.
Yeah, so,
And,
you're diving into a realm of economics that clearly you have some understanding of, some of the rest may not. And so let's just kind of generalize this as saying some of us get utility from something, and that's the value it gives us. Some of us look at a price and think we'll pay a price equal to the value that it has for us. And some of us look at all the labor inputs and all the socioeconomic inputs that went into an asset and say that that's its value or that's its social utility. I guess the point that I'm trying to make here is, as an investor, is there a difference between price and value? Skylar, as an investor, is there a difference between price and value?
I mean, if you're willing to pay that amount, then that is the value of it, as well as the price. I think that kind of touches on the efficient market theory that was in some of our readings, but I guess, yeah, that would be kind of where that's going at.
That's a good point. Alex, you have a good friend, as I recall, by the name of Aswat Damodaran at NYU Stearns. What would he say about the difference between price and value, and who sets one and who refers to the other? Any recollections?
Yeah, I remember that he's saying basically that traders are focused on price, and so they're just like reacting to to the market and based on how the price are going. And on the other hand, some I don't know the exact term, but maybe investor or whatever, they're based on value, and so they're so they're using information to end up with a value. They're not just looking at the price and acting based on that.
Can I interject as well?
Please.
Yeah, and I also feel like as an investor, you have to use them price and value pretty intertwinably, because as an investor, you're typically looking to make a profit. So one, you need to know the value of the company, and then two, you need to know the price, which will typically probably be a little bit lower if it's what they're willing to pay for it, in hopes that the value is a little bit higher in the future so they can make that profit.
So Ashlyn, are you suggesting that a prudent investor would go through the same kind of metrics that Alex and Skylar have given us before they pay a price to determine whether or not the price they're paying is greater than, equal to, or less than the actual value?
Yeah, absolutely. I think it's just as important for them to do it as well as the sellers.
Absolutely. Well, guys, that's a good place for us to leave this off. Skylar and Alex, thank you. Good job.